About 2 years ago, saw three things happening that did not happen in my lifetime before, but happened in the 1930 to 45 period. And they're things I really want to talk about. Then we had the fourth thing, a pandemic. They all happened before. So the first is the going to zero interest rates, the creation of a lot of debt, and the printing of a lot of money to monetize that debt and seeing that cycle happen. That happened 1933. That happened 2008. Very interesting. How does that money flow matter to markets and everything? The second is large wealth and opportunity gaps causing a great internal conflict of values. So if I looked at the statistics, I like to look at statistics, like you say, the mechanics. I saw not only the wealth gap, but the political gap and all of that operating at a level. And it has an effect, right? It has an effect on tax policy. It has an effect on that. But I had to go back to the 1930s and actually before to see such gaps. And the third was the rise of a great power to challenge an existing great power, the United States. China rising to challenge the United States in that changing world order. Because a world order is a system for operating. Our last one began in 1945 at the end of World War II. There's a war, and then there's a new system, and it was the American system, and that's being challenged. And those three things individually and collectively did not happen before that. And then when I studied it, I wanted to study the rise and declines not only of empires, but reserve currencies, because we're printing a lot of money, and what does that mean? And so I needed to study the Dutch, the British, and the American, and that cycle. And what I saw was the same thing would happen over and over again. And if you want me, I'll take a minute on what that looks like, or you direct
So
me.
what happened? What did you learn?
Well, I learned that when there is bad finances, and we have bad finances
Right now.
Bad finances, I mean, if you're spending more than you're earning, and you have a balance sheet that has more liabilities than it has assets, that's bad finances. You can fill that in by printing of money and continue to create debt, but that's not sound finances. Central banks have the ability to do that, and when they do that, that's a problem. So when you have, let's say, bad finances, and by the way, that's happened repeatedly in history. We can see how that's worked and the consequences of it, and we have to understand the mechanics of it. So bad finances, when you have bad finances and you have large internal conflicts, that is a risky situation, particularly if you have a downturn, because the rich and the poor and so on, the left and the right, those with different ideologies, have greater internal conflict. And the internal conflict has a risk politically, and it has a risk in terms of the effectiveness. When people are working well together to be productive, that's great. But if you have bad finances and you have large gaps, and you have the rise of a great power challenging an existing great power, and those things happen simultaneously, that's a risky set of circumstances. So I can get into the statistics of that, how many times of rising power. So you take that and then what are the mechanics of that? So for example, so what does it mean to markets? So for example, if you look at every one of those movements, when they immediately print money and do that, you want to buy financial assets. I'll just take another minute. A lesson that I learned. I was clerking on the floor of the New York Stock Exchange in 1971. This was a year after college and before business school on a summer job. And it was August 1971. I followed the markets a lot. And President Nixon, on August 15th, 1971, gets on the television and he says, basically, that monetary system that we used to have and what money was, we're not going to have that anymore. it will not be, you can't get the gold. At that time, it used to be that money was like checks in a checkbook. They had no value. They would just get you the gold, and then you'd have the gold. And we're not going to do that anymore. And I figured, okay, now I walk on the floor of the New York Stock Exchange the next morning, got there early, figure we're going to have some sort of pandemonium. And the pandemonium that we had, I thought it was a crisis. And the pandemonium we had was the stock market up the most in decades. And I went back and I didn't understand that. And I went back and I found out that the exact same thing happened on March 5th, 1933. It wasn't on TV, it was on the radio. And Roosevelt did the same thing. And the stock market and gold and all of those assets went up again for the exact same mechanical reason. So I learned two things. I learned, first of all, that I better study things that didn't happen in my lifetime before because they might happen again. That's what helped us anticipate the 2008 financial crisis. But I also learned that dynamic that when you print money and create that, that's a hell of a stimulant, but it also means you don't want cash. It means that you want those other assets. So that dynamic is the nature of what we're going through.
Do you want financial assets though?
You want it depends. What financial assets are different things. You don't want bonds. Cash is a financial asset. You don't want to connect cash. You don't want a bond. It's going to have a negative real return. Like, who wants bonds? You're going to have a negative real return. You want that? Okay. And you're not probably going to get the price appreciation through the bond. There are two ways you can make money. It goes up or it gives you a good yield. It's not going to give you a good yield, negative real yield, and it's not going to go up much more when you get down to that. So you don't want the bonds. Stocks have an asset. They're a reflation asset throughout history. So there are things that you want. You want stocks. You want gold. You want tangible assets. You want real estate. You want the things that are basically anti-money. And you particularly want those when there's a large portfolio of those. Think about it right now. Through history, what we accumulate are a lot of financial assets. And the only purpose of those financial assets is to take those and convert them into buying things.
Yep.
And when there's a lot of financial assets and we produce a lot more financial assets, then they're all claims for those other things. And and if you just went through the calculations and you were to say, okay, how much financial assets do you have relative to real assets, or how much are there? There's too many relative to the real assets. And so you want to get into those things that have more of those intrinsic values. A company is. So, and those are throughout history, you see that pattern.